Welcome back to the Digital Asset Report. Crypto markets are starting June marking down. Bitcoin is trading under $71,000 and Ethereum is back below $2,000 as of Monday morning. The move comes as spot Bitcoin ETF outflows have crossed $2 billion, with higher oil prices and geopolitical risk weighing on risk assets. Our lead story today comes from the CFTC. On Friday, the agency approved Kalshi's Bitcoin Perpetual futures contract, the first regulated product of its kind in the US. Coinbase also received a path for eligible US clients, beginning with institutions, to access global crypto options and perpetuals through Deribit. Perpetual futures are one of the most active products in global crypto trading, but for years, most of the volume sat offshore. Now the CFTC is bringing that activity into the US regulatory perimeter. This matters because it's a shift away from blocking crypto market structure to supervising it instead. The CFTC also issued guidance on 24/7 trading, clearing, and settlement. The agency said crypto derivatives may be well suited for always-on markets because of their digital infrastructure and global reach, while other asset classes may not be ready for that model. That is a clear recognition that digital asset markets operate differently, and regulation is starting to adapt. US crypto traders have been largely blocked from access since the inception of platforms like BitMEX and Deribit, but this begins to clear a path towards reshoring digital asset product access. Meanwhile, Treasury Secretary Scott Bessent has mentioned that the US seized $1 billion of Iran's crypto assets. Take a listen.
I believe that we have seized about $1 billion of their crypto. And
just outright seized it.
Just outright grabbed the wallets. Some of them may be like typing in right now and realize they might not realize that their wallet had been grabbed. And we are working with our allies all over Europe to grab villas and houses and properties. And this is money that's stolen from the Iranian people.
This comes as the peace deal in the Middle East has been stalled for weeks. In other parts of the world, Japan is moving on its own digital asset framework. A ruling party panel urged the government to promote yen-based stablecoins for settlement across Asia and to create a legal framework for crypto ETF trading. Japan's top banks are already working on stablecoin issuance projects with support from regulators. If that plan advances, Japan will be building both the payment rail and the investment wrapper at the same time. On the stablecoin front, the policy debate is getting sharper. Bank of England policymaker Megan Green said tokenized deposits may eventually overtake stablecoins because they sit inside the commercial banking system. But Federal Reserve Governor Christopher Waller defended stablecoins as a payments innovation that can lower costs and add competition. That split captures the fight now happening across global finance. Banks want deposits protected, while crypto firms want open payment rails. And regarding the pending Clarity Act, JP Morgan CEO Jamie Dimon said that stablecoin issuers should have the same rules as banks.
How do you see the Clarity Act changing things?
Let me just rephrase it. We're not worried. We think it should just be fair. If he takes deposits like a bank, he should have bank rules. We have social requirements, liquidity requirements, capital requirements, AML requirements, financial reporting requirements, transparency requirements. If he wants to be a bank, be a bank. That's all it is. And the second issue, not really related to rewards and interest on stablecoins, is also about AML, BSA, KYC, because when you earn a bank system, it's already been through all of that. Okay? And we do that because we have to for the federal government. And so if they want to be moving money around the world, on any basis, you should ask the question, can that be used illegitimately, easily? And the answer would be yes, unless they follow the same rules.
Right, they're not FDIC insured.
And they're not FDIC insured. We have requirements to build branches in lower income neighborhoods. We have liquidity requirements and capital requirements, reporting requirements. We have like 84 regulators all over us. We're just saying it should be fair and equal, period.
In other news, the tokenization story has also advanced. DTCC said its tokenization service will connect with Stellar as part of a broader multi-chain strategy. The plan is to support DTC custodied assets like stocks, ETFs, and treasuries on public blockchain rails, with Stellar access expected in the first half of 2027. Corporate treasuries are having a symbolic moment too. A strategy disclosed that it sold 32 Bitcoin for about $2.5 million, its first Bitcoin sale since 2022. The company says the proceeds will help fund preferred stock dividends. Strategy still holds more than 843,000 Bitcoin, and this small sale represents a very small portion of their total holdings. Saylor mentioned this may happen a few weeks ago in an effort to inoculate the market. Meanwhile, Vivek Ramaswamy's Strive expects to add a new $4.2 billion in total ATM offering issuance capacity. $2.1 billion of that is for its SATA preferred stock, and another $2.1 billion for its ASST common stock. In other developments, Aave is tightening its asset listing standards after the RS-ETH exploit exposed bridge and collateral risks across DeFi. Separately, Sui suffered 3 mainnet halts on May 28th and May 29th tied to bugs from its 1.72 upgrade. No single incident changes the whole industry, but together they show that security, uptime, and operational controls are now central to institutional adoption. The week's message is clear: prices are weak, ETF outflows are large, and treasury firms are under pressure. But the regulated rails are moving forward. US perpetuals, Japanese stablecoins, tokenized deposits, DTCC tokenization, and stronger DeFi risk controls. That's it for today. If you enjoyed this video, be sure to give us a like and follow along for more.